Thanks so much for having me. I appreciate really the opportunity to really talk about ESG data and the state of ESG data. It was a little bit painful, I have to admit, putting this paper together, but I'm grateful that I did. And I think that, I produced a survey really of where ESG data sits today, as well as I think some of the lessons that we've actually learned about how to go about constructing ESG measures that focus on material risks and how to actually go about, integrating ESG in portfolio construction. So I don't think I can cover, everything today, obviously, in the paper. So I just wanted to kind of highlight a few elements of the paper. And the first point that I really want to make is that there's actually really no need to be confused by ESG data or by ESG ratings. Really the key, I think, to cutting through a lot of the confusion is to understand what actually your objective is as an investor, which may be different from another investor. And I think that it's great that Amy and Brett has gone through some of the historical background for the evolution of ESG. I think that's a very important context to have. But the truth is that ESG is not really as all over the place as everybody thinks it is. We do actually have some common understandings today that ESG has multiple dimensions. And so one of those dimensions can reflect, for example, personal values, which are idiosyncratic to the investor. Another dimension can reflect a concern with the real world impact from investments. And then finally, another dimension, which is one that we talk about quite a lot, is reflects really the financial impact on the investments from ESG issues. So, the world of ESG data information is actually very, very broad. So this is really just a schematic of all the ESG data sets that are available from MSCI that investors are using for different objectives that they have in their investment processes. And so, the point of really just showing you this menu of ESG data sets in the market is to really just make the point that you should really be thinking about ESG data as ingredients, right? And they're ingredients that can be assembled to capture different dimensions of ESG. However, because these are multiple dimensions, you can't really reflect all of the different dimensions at the same time in one single score or one single rating. So when you're reading studies about comparing scores that are all labeled ESG ratings, really the first thing to ask is whether or not those ratings are really trying to capture and measure the same thing, because we know from historical reasons, some of the papers that have been that are referenced by Brett and Amy, as well as other authors at the panel, that they actually are not necessarily trying to capture the same thing. And so differences between ratings can actually come from differences in their intention, as well as potentially differences in effectiveness, right? So they could be trying to measure the same things, but they are not equally effective at capturing them. It's also, of course, possible that two ESG signals or ratings are highly uncorrelated, but they're actually each highly effective at capturing what it is that they're aiming to capture. They're just different things that they're trying to capture. So I think this is an important distinction to kind of set out. The second point I do want to make is about sources of ESG data, because there's a very narrow view, I think, out there that ESG data consists primarily of corporate disclosure, and that's just simply not true. There is actually much more ESG data and information about a company than from a company. And so even as we all get very excited that there's the prospect of more standardized and more corporate disclosure coming online soon, that we still really need to be developing a lot of alternative data sources on ESG information about companies, because those really are high quality and important critical elements in the landscape of ESG data. All right, so let's talk then about ESG materiality. So among the many ESG data sets that we construct for different investors and use cases, the one that probably has the highest profile is the ESG rating. So our ESG rating really aims to capture the long-term resilience of companies to emerging ESG risks, and to achieve that, the ratings model really is actually only incorporating a small handful all of the ESG issues and data points that we collect on any given company, and which which data points and issues they are really differ quite substantially between industries. And because we're constantly trying to improve our ability of the ratings to capture that long-term resilience, this model is not static, but we have deeply studied and dissected our own rating over the years, and we've published a number of studies out there, and I reference a number of them in the paper if you want to follow up on specific points here. But I wanted here just to spend a minute to talk a little bit about the fundamental approach that we take in investigating our own data. So we think it's important to really distinguish between the different kind of economic channels through which material ESG issues as captured by our ratings can impact company performance. So, we have also dissected how individual E, S, and G issues might actually operate differently through those different economic channels, which is something else that we, a stream of research that we've also started doing. So, but to summarize, what we have found is that over 13-year history of ESG ratings, companies with higher ratings are more competitive than their industry peers. And so as evidenced by the fact that they tend to have a higher profitability, which is the chart on the left, as well as they pay greater dividends over time. And then, on the downside risk side, we have very consistently across different markets and across different time periods been able to find evidence that ESG ratings can approximate inferior risk management that can precipitate negative events. Right? So we found that the lowest rated companies over the next 3 years are 3 times more likely to experience a very severe stock market drawdown, stock price drawdown compared to their highest rated peers. And so that's the middle chart. Now, in terms of systematic volatility or systematic risk, what we have found is that more highly rated companies have shown lower volatility. They have tended to be potentially less susceptible to systemic shocks in the economy, and that was something that was sort of demonstrated in part last year through the COVID crisis, where we really did see higher rated companies perform better and was more resilient during that period. All right, so in the paper, I do go over some lessons that we have learned in terms of constructing an ESG rating, and there are a lot of investors who are making their own proprietary ratings or adjusting ratings, and I think that at a high level, one of the more important things to know is that what we have found is that E, S, and G issues actually impact financial performance over different time horizons. So some issues are actually just more susceptible to or are better at capturing event risk. So those are shorter term time horizon types of impacts. And then other issues, particularly kind of environmental issues such as carbon management, are the sorts of issues that actually accumulate advantages over time. You're only going to see that financial impact over a multi-year period. And so so the reason we think these things are important really kind of gets back to the beginning of what I said, which is that investors have very different objectives, right? And so to the extent that you are an investor that want to be capturing over a 1-year time frame some sort of event risk, then you would upweight governance-related issues. Whereas if you are a long-term universal pension fund, as Brett and Amy were talking about, some of the kind of more slow-burning issues like environmental management and actually some social issues that we have seen, it really does take multiple years, but you do actually see this cumulative difference and cumulative advantage that companies have over time when they are superior on some of those issues. So let's see, I don't think I have time for that. So I did want to end with just a note on sort of integrating climate risk.
1 minute.
Because okay, because I think this is just really kind of an additional dimension of risk that needs to be accounted for separately and urgently. So last week, MSCI issued a kind of a call to action statement, really urging all players to actually start taking action, because the truth is that the transition to this net zero economy is going to involve huge shifts of allocations of capital, as well as that will then trigger a repricing of financial assets. And you can see that where we need to be, which is the blue shaded area on this chart. These are the publicly listed companies in the world where they would need to be to get to net zero by 2050, is very far from where they're actually headed, which is the dotted line of the emissions trajectory. So what I do want to say is that, we are probably headed for a period of Schumpeterian creative destruction, and there's going to be a lot of opportunities as well as very unprecedented risks for investors and for companies. So so in the world of ESG data, where I sit, a lot of the most interesting and cutting edge developments right now are actually in measuring, finding measures for climate risk and the different dimensions of climate risk for companies and for portfolios. And that probably is a whole different session and conference. But I think I would be remiss not pointing out that for those of you who are thinking about ESG data, there is going to be a whole expansion of ESG data and metrics and measurement purely kind of devoted to climate risk.